Hi everyone. Today we're going to be talking about buying a home, the whole overview of the process, how it works, and what you should expect and do along the way. Let's get rolling. So before buying a home, you want to get the best possible APR. You learned in the previous lessons that a lower APR can make tens of thousands of dollars of difference in the total interest you pay. So getting a low APR is really important. The best way to do that is before you buy a home, years before you buy a home, start building a credit history. What this means is when you buy a car, take out a manageable loan. Even if you don't really need to take out a loan, it might be worth to borrow a little bit of money to pay off the car so you can have that history of making payments. Use a credit card to make small, regular, normal purchases like buying your gas for your vehicle on your credit card. Pay it off every month. Don't let that balance sit there or build interest against you. That will help you show that you have a good credit history and a good history of making payments without charging large amounts of interest. If you can't trust yourself to not overspend with a credit card, don't get a credit card. The damage it can cause is more than the help it can have. And remember to keep older credit accounts open. So don't close an old card and get a new card. Keep that old card open. Reduce your debt. So try to pay off as much debt as you possibly can. Get those credit cards fully paid off. Make sure that if you have a car loan, get that paid off if possible. Anytime you have, the more debt you have, the less the bank will think you can afford to buy a house with. And then save up money for a down payment. You're going to need a down payment and to pay closing costs. So you're going to need a significant chunk of money to buy a house. 20% for conventional mortgages, although most people don't save that money, most people use that 20% from a previous house. So for your first house, you're going to save up maybe 3 to 5%, and then be able to buy a house using a government-backed mortgage or just a higher interest conventional mortgage. And remember that the down payment can be as low as 3% with some government-backed mortgages. In fact, a VA loan doesn't require any down payment at all. All right, next thing to do is figure out what you can afford. So to do this, you're going to try to not spend more than about 30% of your pre-tax income on housing costs. So just take what you make in a year, multiply by 0.3, and that's the number that you want to kind of hit for in terms of your housing costs. That being said, you know your financial situation better than anyone else. So you know how much you can afford. If that 30% feels too steep for you, then don't use that number. That's just a rough number. And know that lenders will often approve you for more than what you think you can comfortably afford. They're looking at, hey, how much can they possibly afford? If that's more than what you want to spend, don't be fooled by lenders. They don't know your exact situation. So just because they approve you for something doesn't mean that you can actually afford it. It just means they think you can. And then the term house poor is good to have here. So house poor is when you spend so much money buying a house, you don't have any money left over to do anything that you want to do or enjoy doing. So you become house poor. All your money goes into paying your mortgage, and no money left over. All right, there's a few philosophies around buying a first home. The first one says, buy as big and expensive a house in the best neighborhood you can possibly afford. So really go all in with your payments. The logic behind this says that, hey, the payments will be hard at first. You'll be house poor at first. But over the next few years, as you get raises at work and you move up through your job, you'll find that the payments are easier and easier to make. And then your family can grow into that house over time because you got a slightly larger house or a nicer neighborhood or somewhere you want to be longer term. So that's that philosophy. The other philosophy says, hey, you know what? Buy a smaller property, something that you can easily afford, but maybe you don't comfortably fit in. So maybe it's smaller than what you would really like, or maybe it's a condo instead of a townhouse, or a townhouse instead of a single family home. Um, that way you have money for other priorities like saving for your future, building a emergency savings account up faster, all those kinds of things. And then if you need more space in 5 to 10 years, you could always sell that first starter home and buy a second home that fits you better then. The only drawback to this method is that if you do sell in a short period of time, like 5 or 10 years after you buy a house, you don't make much money on the house. You learned that in our previous lessons that you pay off small amounts of the mortgage at first. So during that first 5 years, you don't pay off a huge amount of the mortgage. And then also moving and selling a home is expensive. So you'll lose money from that as well. But this is a more conservative approach. So if something goes wrong in life, if you've taken this second approach where you bought a smaller property, you're more likely to be able to hang on to that property and not lose your home. All right. Before you buy a home, you need to get pre-approved. What this looks like is you're going to talk to several lenders. So talk to your bank, other banks, go online. You can apply for loans at lenders all like a whole bunch at one time. And you're looking for the lowest APR, which is the most important thing because that's going to have a huge impact on your overall amount of interest you pay, and closing costs. So closing costs are all those fees associated with getting a loan. Those are usually more competitive. Most banks have very similar closing costs, but they can vary by a few $1,000s. So look for some low closing costs. But don't take a loan with a high APR because of low closing costs. You'll end up paying more in the long run from that APR. In Kitsap County, if you buy that median house, your closing costs are between 3 and 5% usually. That could be $15,000 to $25,000 of cash you have to come up with for closing to pay all those fees, lawyer fees, title fees, all kinds of interesting things that happen during a loan. After you get pre-approved, the lender will give you a letter. Most sellers like to see that letter so they know that, hey, at least you've gone through that process of knowing how much you can afford. No one wants to go into an agreement with someone buying their house when the person buying the house has no idea how much money they can actually afford, because those deals tend to fall apart really easily when the person buying the house finds out, oh, well, no one's going to give me a loan. So it's good to have that pre-approval letter to make you look more serious. And then do your research. You want to research the quality of schools, how far it is to go to and from work each day. I would even drive that route a few times in the morning and the evening to see what that traffic is like. All the things you could think of. Go to open houses in the areas you want to go to. So an open house is when someone's selling their house. They'll have a day when just anyone can drop by during like a 3-hour period and just check the house out and see what's going on. Go to a bunch of those just to get a feel for the quality and expense of the houses in the neighborhoods you might want to live in. So during the process, find a real estate agent that you can trust. They'll be guiding you through this entire process, and you'll be making this biggest purchase of your life. So it's good to have a trusted professional with you. Traditionally, sellers, the people selling the house, would pay the commission for both real estate agents. So basically, the seller, the person selling the house, would pay 6% to their agent, and their agent would split that with your agent. So you actually don't pay your agent any money. Things have changed in the last few years, and while this is still the most common way for agents to get paid, sometimes your agent, the buyer's agent, you'll need to pay them directly, and there'll be a contract that details all of that. But remember, if you don't buy a house, typically your agent does not get paid. So make sure when you get a real estate agent that you are serious and ready to buy a house. You don't want to use an agent to go out and look at 30 or 40 different houses and then not buy anything, because all of their time was then just wasted, basically. They get paid nothing until you buy a house. Most agents will require you to sign a contract with them. So that contract will say that, hey, you're going to use them and only them for purchasing a house. Usually there'll be a time limit on that contract. What they don't want to do is they don't want someone to go out and just hire 5 or 6 different agents to go out and find houses for you. And then all the ones who don't find a house for you, they just get kind of screwed and their time is wasted. So really they want you to just be one person with one agent. Make sure you read the terms of the contract. They're important for you to know, and ask questions about how they're being paid. So during this process, go look at a bunch of houses with your agent. Look in your price range. Your agent know what you like. Tell them what you like and don't like about each house. That way they can start tailoring their houses to the things that you want and don't want. Once you find a house that you want to buy, now you have to decide how much you offer for that house. So there's going to be an asking price. The seller will be like, "Hey, we wanted to sell it for $550," and you might be in a market where offering less than that's okay. Offer $540 and see what happens with that deal. Sometimes the market's really hot and lots of people are buying houses, and you may have to even go over the asking price. Your agent will help you understand sort of where you might land, but in the end, you have to decide on what that number is. Once you decide on that number and you want to make an offer, the agent will fill out an offer letter with the details of your offer spelled out. Afterwards, if the seller accepts the offer and says, "Yes, that sounds good to me, let's do it," or the seller might say, "No, like I don't want to. I want the 550, not the 540," or maybe they'll meet you in the middle and say, "Hey, how about 545?" At some point, you're going to both agree, or you're going to walk away from it. When both accept the offer, they'll create a formal purchase agreement. In this agreement, there's going to be all the details of the purchase. So there's going to be the price of the purchase, the closing dates, and a bunch of other information about appraisals and home inspections and all kinds of stuff. So it'll be a big agreement. Make sure you're reading all these documents. Earnest money deposit. So when you make that purchase agreement, it is typical that you put up between 1% and 3% of the purchase price. You set that money aside in a special account, and that's called earnest money. What this shows is it shows the buyer that you're serious about buying the house. If you walk away from the deal, you just say, "Hey, you know what? Never mind. I don't want to do this." You will lose your earnest money. That money will go to the seller as compensation for you kind of jerking them around. If you back out of the deal because of problems like financing, or maybe there's a when you do a home inspection, there's big problems with the house, those things you can walk away from the deal without losing your earnest money typically. If you go through with the purchase, the earnest money is then just applied to your down payment. So that money comes back to you as well. The only way you can really lose your earnest money usually is if you just walk away from the deal and just say, like, "I just don't want to do this, I'm leaving." Usually you can find a way to kind of get out of it, but earnest money does sort of put some skin in the game, if you will. Contingencies. Here's another important thing to understand. So these are the protections for you that allow you to back out of the deal without losing your earnest money. Contingencies need to be offered and included with the purchase agreement, not the offer letter usually, but oftentimes they are as well. But they definitely be part of the purchase agreement. Some common contingencies that you should definitely have are financing contingency. What this says is it'll say, "Hey, by a certain date, I'll secure a loan from my lender and I'll get the final approval for the loan. Otherwise, I can walk away." So that's the first one. Home inspection and contingency. Again, it'll say, "Hey, by this date, I'll have a home inspection done by a professional, and then I'll be able to either renegotiate the price with you at that point or walk away from the deal without losing my earnest money." Appraisal contingency. So an appraisal is where someone comes out and sets the value of the house. Says, "Hey, looking at all the houses around that have sold, this house's value is X." If that number is less than the agreed price for purchase, then you have an opportunity to walk away from the deal as well if you have this appraisal contingency. These are all like paragraphs inside of a purchase agreement. Just be careful that contingencies also make you less attractive to a seller. If there's a bunch of contingencies as a seller, I know that there's options for you to walk away from the deal. I don't want that as a seller. I want to sell my house. So if someone waives their contingencies, meaning they don't have any, that's a safer deal for me to move forward. So just know that that's the case. These three contingencies are really common. You should be very careful about waiving these three contingencies. So after the purchase agreement, your lender will require an appraisal. So remember, the house is collateral for the loan. So the lender, your bank, is going to want to know that that house is really worth what you say it is. So an appraisal is a professional comes out and they value the house based on other houses that have sold that are like that house. And they say, okay, this house is really worth, $530,000. And the lender says, well, wait a second. Um, you agreed to pay 545 for the house. We're going to want a bigger down payment to cover that difference because it's really only worth 530. If that happens, you can renegotiate the price with the seller, or you can walk away if you have that appraisal contingency. Also, you have to get a home inspection by a licensed, experienced inspector. Your insurance agent should be able to hook you up with some people who are really good inspectors. They go out to the house and they just go through the whole house trying to find anything wrong with it. They'll give you a long, like 30 or 40-page document that has pictures and descriptions of all the things that need to get repaired or fixed or that might be wrong with it. Inspectors don't move stuff in the house, though. So if they're in the house and there's a sofa that's covering up a problem and a wall, they won't see that. So know that it's not a foolproof problem, but they can find lots and lots of stuff. If there are major problems, you have a couple options. You can ask the seller to repair them before they sell the house. You can renegotiate the price. And if the problems are major, you can even walk away from the deal and say, hey, you know what? I don't want to buy this house anymore. After the purchase agreement, work with your lender to finalize the loan details. You've got to get this done quickly. You're going to need to provide lots of evidence of like income, tax statements, proof of down payment, all sorts of information your lender is going to want, and it's going to take them weeks to go through their process of approving the loan. So make sure you get all that started right away. On the closing date, you'll sign all the final loan documents. It's going to be dozens of signatures. You'll transfer the down payment to the seller, and you get the keys to the property. This is the point where the house or the property becomes your property. It's legally yours, which is really cool. And now you are a homeowner. So don't be afraid of the process. It is complicated, but you're going to have an agent there helping you through each step, and they're really experienced at making it go smoothly. All right, everybody, have a great one.